Are stocks too high? A historical perspective. Could stocks give us a less than 1% a year return, real return, when you factor inflation over the next 10 years? Ooh, let's talk about this. This is going to be interesting. All right. Welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn all about investment management, financial planning, taxes, retirement, you name it. We're going to talk about it here. And I don't have all the answers. So if you want to comment or give me links to look at, by all means do so. I love hearing from my subscribers. So by all means, comment and thumbs up as well. They both help me a lot with the YouTube algorithm. So we're going to look at Bob Shiller here, Robert Shiller from Yale. Are stocks too high? Historical perspective. And this just came out in September of 2018. And we got Shiller. That's Shiller right there. And I think that's his partner, Campbell. And we're going to talk about both these guys here right now. Just remember, Shiller is a guy who penned the book Irrational Exuberance, which based on his Case-Shiller Real Estate Index, they called the bubble in real estate. And then I think he also called the bubble in the stock market as well in the late 90s too. So he called the bubble in real estate in 2006, something like that. And then he called the stock market bubble in the late 1990s because of the Case-Shiller Index and then his CAPE, cyclically adjusted price earnings ratio, which we're going to talk about here. All right. So introduction, S&P prices and earnings since 1871. The blue is the composite price index, and the green is the earnings going back historically. And as you see, the green is historically above the blue, which means that the prices are lower than the earnings are growing, if that makes sense. So the prices grow, but not nearly to the extent that earnings grow. And so what we see here is a significant, basically the prices are well below what the earnings are on a year-over-year basis. But then we see here in 2000, right there is 2000, when that changed, and pretty close to the first time ever. And if that's not mistaken, that's Greenspan's when he said irrational exuberance, when the earnings and prices started coming close together for the first time, basically ever, other than the Great Depression. Here's when Shiller was calling the market, and again, that's Greenspan right there, I'm sure, and that's Shiller in 2000 when he said, "Hey, the market's way too high." All right, so the interesting thing is about this chart is you see that mostly the green is significantly higher than the blue, and the vast majority of time. The green is the earnings, except right here. Look at that. So the earnings were well below in 2009 what the prices were, which would have thought one would say that means the market is way high and you should be a seller. Well, if you would have sold there, you would have missed out on some of the extraordinary gains over the next 8 years. Conversely, right here, the earnings were way high. That's 2006 or so. And that would say, hey, the earnings are way high relative to prices, so I'm going to be a buyer. And again, if you would have done that, you would have lost your shirt, and then you would have done the same thing, sold here. That's the exact opposite of what you should have done. You should have sold here and bought there. Now, no one knew, and that's a drawback. And of course, no one knew here. I mean, the earnings and the prices were meeting basically 50-50. So no one says, oh, that means earnings are doomed relative to the price. We just didn't know. But I mean, historically, when earnings and prices they hit the same target, that's a cause for concern for sure. And again, I think that's when Greenspan did his irrational exuberance speech, which is how Shiller came up with the title for his book. All right, so introducing the CAPE ratio, the cyclically adjusted price to earnings ratio, or the Campbell-Shiller PE10. I'm sure that the other guy was Campbell, which was defined by John Campbell and Shiller in the 1980s. I'm not familiar with Campbell. I'm certainly familiar with Shiller. Campbell's a little bit before my time. It characterizes the strong relationships between inflation-adjusted earnings price ratio and subsequent long-term returns. It is often used to identify long-term trends and overvaluations or undervaluations. It does have both its critics and its advocates. Advocates generally point to the basic idea of smoothing earnings over business cycles as intuitive and sensible. So let's go back to this chart here. I mean, again, if you just looked at a PE ratio time, you'd be like, oh man, earnings are well above valuations. We should be a buyer because the market's way undervalued. And then if you looked at here and say, oh no, earnings are way low relative to valuations, we should be a seller because earnings are way high to value. And both of those would have been the exact opposite thing of what you should do. Let's see. So it's got critics, on the other hand, mainly focus on the ways to claim that observed CAPE ratios are too high, specifically because the differences between traditional and smooth PE ratios. So again, we're cyclically adjusting the PE ratios. We're saying we're going to use inflation over the last 10 years relative to the prices of stocks and the earnings growth. We're going to take those two, adjust it for inflation, and smooth it out over 10 years so we can avoid any one-time thing like we had in 2006 where earnings are way up here, and a one-time thing like we had in 2008 where earnings are way down there, which was distorted what a true investor would do. If you're a value investor, when earnings are way high in 2006, you're going all in. And that's just a fact, and that's not what you should have done. And then the critics will say accounting standards have changed. And that's true. Critics often cite price to earnings as just as good as the CAPE. However, even on a simple inspection of the 2 time series, landmark events are not particularly as apparent in just basic PE ratios as they are in the CAPE. And for you on my podcast, I am going to put this on the podcast. What you can see here is the markets going back to 1870s are choppy. I mean, relative price to earnings ratios, if we start at 10, we go up to 25, we go down to 6, we go up, it's choppy. So it's hard to get any kind of specific situation that says, oh, we're way high or way under. We just don't know. And then, of course, the way we just talked about in 2007, it looked like we're way undervalued because earnings were through the roof. But now if you look at the CAPE, on the other hand, the PE ratios in 1929 were through the roof. I mean, that's just a fact. We're up to about 35. Conversely, in 1920, the PE ratios were way low. So if you bought in 1920, you're doing good. You're buying low value stocks. Whereas if you sold in 1929, you're selling high value stocks. Again, high valuations relative to prices, which means in terms of buying at a discount, you're not buying at a discount in 1929, but you were buying in 1920. And then again, you go back 2000, you're certainly not buying at a discount in 2000. So you want to sell there. But if we look at 2009, you're buying a steep discount relative to the cyclically adjusted PE ratios. So that just says, hey, there's when you adjust it for the 10 years and you inflate it as well with the cost of inflation, real returns, you can see a lot more of the anomalies that will strike out at you and say, ew, that looks like something to contend with. Introduction, forward-looking prospects. So the CAPE is currently at 33, beginning in September 2018, and history is very clear. The average 10-year forward returns decreases as the starting value of the CAPE increases, with both worst case and best cases getting weaker. So remember, we are at 33. So the average return when you're at 33 is a 0.9% adjusted for inflation. This table is a compilation of the 10-year forward returns of the S&P 500 over every possible rolling decade since 1926 for starting different CAPE ratios, and then separated by deciles, the 10 every 10. So right now we're at 33.2. The low in this model is 26.4. The high in this model is 44.2 historical averages. So we're basically saying the lowest, whenever we've been at a 33.2, the lowest we've ever been is 26.4, and the highest we've ever been is 44.2. In that case, so that's our range, all right? So basically, when we're smack dab in the middle, we've had an average since 1926 on any rolling 10-year periods, a 0.9% real return, again, after inflation. The worst case scenario over 10 years has been a negative 6.1. The best case has been a positive 5.8, and we've had a standard deviation of 3.4. So not much of a volatility there. So on the other hand, the lowest valuation was 8.6, where we had an average rate of return over the next 10 years of 9.8, a worst case scenario of 4.2, and a best case scenario of 17.2. So all this is saying is the higher the CAPE is, the lower the projected returns have been, or not the projected, the lower the real returns have been going forward. And that simply makes sense. The higher, the more you're willing to pay a premium for a stock, the higher you're paying for it. The more dollars you're paying for a dollar of earnings, the more likelihood your returns will be disappointing going forward. And given the fact we're at a 33.2 CAPE right now, that will lead one to believe, based on historical numbers, that we can project a real return of less than 1%. Kind of scary. All right, so let's keep going. All right, so we're going to keep going down here. Multiple horizon predictability regressions. We note that a full list of predictor variables, the data source of any complementary academic references below. So they're using a bunch of different predicting return academic theories. So we have our earnings to price, reported earnings. So again, PE ratio. We got the national income and production accounts, which is what Jeremy Siegel over at Wharton's does from the Bureau of Economic Analysis. So again, he's using NIPA. That's what Siegel would offer is a better one because accounting numbers have changed. Operating earnings relative to the price. So you got operating earnings relative to the price. dividends versus the price, book value versus the price, cash flow versus the price, and sales versus the price. So we got a bunch of different mechanisms to give us a suggestion of what future earnings will be or future price returns relative to what the academic model that you're using. And here goes Shiller. The predictability literature is rich, especially on the robustness of running long-term predictability regressions. Again, we're predicting what the future will be given these different models. All right, so as such, there are spurious of long-term, and he's talking about statistical stuff. We're going to go by that. Multiple price to earnings predictability or multiple predictability regressions. He talks about the R square. I don't want to talk about that. And you can be statistical. That's going to bore most people. So I'm going to go back. I'll go on the next one. However, when you look at the statistical probability as a predicting for the next 10 years, CAPE or CAPE specifically with its yield, again, 33.2, is by far the most consistent predictor of subsequent equity returns at both shorter and long term. And for you on my podcast, you won't be able to see this, but this can be tough. But the CAPE is, if you are on this, is a dark blue right there. And what you can see is it gives the most statistically predictor, the consistent. It's consistently consistent in its predictions of long-term performance. So here's 10 years, and over 10 years, this dark black one, which is going to be cash flow over price, has given us the closest thing to what has happened over 10 years, but has been a lot more of a range between the shorter terms. So so basically what you're doing is you're saying after 10 years, the cash flow over price has been the most consistent for 10 years, but it hasn't been the most consistent for 5 or 7 or 3. Whereas the CAPE has been the most consistent accordingly for 3, 5, 7, and 10 relative to predictability of performance. Does that make sense? So again, it's tough to say, but there has been something that's more of an anomaly. Cash flow over price over 10 years has done the best for those 10 years. But how about for 7 years? It hasn't done the best. How about for 5? And what has been the most consistent for shorter and long term has been the CAPE for sure. All right, so let's keep going down here. So we're going to compare some alternatives. Jeremy Siegel has been a strong critic, and he's a friend of Shiller, so they're not fighting. Has been a strong critic of CAPE because of reporting earnings and its construction. Changes in accounting rules since 1990s may have led to a downward bias in reporting earnings, resulting in an upward bias of CAPE. Thus, the current overvaluation of the market is indicated by CAPE may not be well justified. So Siegel is saying, look, they changed the accounting rules back in the mid-90s. That has led to the CAPE showing a higher valuation than what is true based on what Siegel used, which is the National Income and Product Accounting from the Bureau of Economic Research. All right. So in this case, we're going to evaluate the Siegels and a couple of the other models that we're going to use. Siegel strongly advocates the use of the NIPA profits as opposed to reported earnings. So reported earnings are what the PE ratios are based on, price earnings. What did company X do? GE, remember GE? What did company X do? Lockheed Martin. That's what reporting earning is, as opposed to NIPA profits, which is the National Income and Product Account profits. He finds that by doing so, the market is not as overvalued as the CAPE would suggest. In fact, so he's saying at the end of the day, while the market might not be quite as highly valued as what CAPE is, it's still pretty highly valued relative to historic norms. It's still well above this mean for sure, which is kind of funny. Not funny in that it's wrong. Just as at the end of the day, we're still pretty highly valued relative to its norms. Now, what we can see here, if we're looking at total return profits, the mean is a little bit higher than the mean for the Siegel thing, whereas the CAPE is quite high relative to historical profits. But now what we do is where we take it. So now Shiller says, well, we also confirm Siegel's numbers, but then they evaluate it. This is pretty funny. So basically right now, the Siegel's, which is the more conservative of the valuations, is 27% above its historical mean. All right. So Siegel is saying, even though the NIPA data is a lot more, what's the word I'm looking for, conservative in terms of estimating valuations relative to the price, even that is 27% above its historical mean. So what that means is based on those numbers historically, given what we would look at for the next 10 years, the Siegel model would say basically a 4%, 3.97 to be specific, real return forecasted over the next 10 years. And that's, Siegel would not, I don't think he'd shy away from that. He'd say, yeah, basically 4.5 real return over the next next 10 years. Whereas the Shiller model with just earnings per share is giving us a 1.73%. Based on today's current, at the end of 2017, a 10-year realized or 10-year annualized total return. So 1.73 based on the end of 2017, cyclically adjusted price to earnings. So that's pretty bad. So 1.73 for Siegel or for Shiller, or 3.97 for Siegel. Neither one's nothing to write home about. Now, if we look back from 2015, what were they saying? So we're going to say the total return, this is in January 2015, the next 10 years, Siegel was predicting 5.25% real return. This is at the end of 2015. And Shiller is predicting a 2.81. All right. So again, they've been off by roughly 3% or so, 2.5%, 3%, 2015 till to end of 2017. But either way, Siegel's is still gone down relative to what Shiller's was back. Still gone down relative in the end of 17 relative to what it is at the end of 2015. And Shiller's has as well. So Siegel's is 5.25, now it's 3.97. Shiller's was 2.81, now it's 1.73, which is telling you the prices have gone up. But the methodology adopted by Siegel in 2017 is to splice the earlier history of reported earnings to that of the operating earnings with NIPA per profit share. So when they become respectively available. So what, like Shiller says, instead of using econometric techniques to splice two different histories together, we simply reevaluate conclusions used on only actual reported observations, as opposed to splicing stuff using economic models. And when we do that using actual reported data, we do not get a 3.97 projected rate of return over the next 10 years under the Siegel model. We get actually a 3.06, and relative, which is 25% lower than the initial model that Siegel was showing us. And relative to Shiller's, is still higher, 3.06 to 1.92. But Shiller is showing us a 1.92 based on earnings per share analysis. Again, reported earnings per share. Either one is still quite high. And none of them you're going to write home about and say, oh, these are great returns. All right. Siegel, and he talks about operating expense and operating earnings. I'm just going to talk about that because PE ratios versus operating earnings versus NIPA, at the end of the day, they're all way low for forward projected returns relative to historical norms. All right, which is why I use 7.5% in my forecast. That might be on the high end, but for stocks, I think that's reasonable. But you don't know. Long term. Okay, I want to show you something though. We'll wrap this up here in just a second. All right, we'll see. How can investor use it? Okay, so I want to talk about this right here. At the beginning of September 2018, CAPE for the U.S. equity market is 33. Again, we're talking historically high. How to best use this, and what they're saying is, let's see, let's go to, I want to show you right here. The negative relationship between CAPE with subsequent returns is not just factored in the U.S., it's also evident internationally. So going back to the MSCI UK, so this is UK index, the higher the CAPE, which the CAPE ratio is on the right, the lower the subsequent returns for the next 10 years. And you can see the lower the CAPE, the higher the returns, the higher the CAPE, the lower. It's like, I mean, it's incredible, actually. Here's the Japan, same time frame. The higher the CAPE, the lower the return. So the CAPE in this regard, if you're looking, is on the right-hand side is the higher the CAPE. On the left-hand side is the higher the returns. And so you can see, and here's Europe from 1999 to 2006. The higher the CAPE, significantly the lower the return. So much more inelastic. Is it inelastic or elastic? I think it's inelastic where it drops off. So I can't remember from my economics. But anyway, there's a much sharper curve for Europe from 1999 to 2016, which says as the CAPE was getting higher and higher and higher, the subsequent returns were lower and lower and lower. A more flat one in Japan, which says the CAPE was getting higher and higher and higher. It was less than of return going forward, but wasn't quite as dramatic. And then in UK, it's pretty dramatic as well. Again, the higher the CAPE from UK, Japan, and overall Europe, the lower the returns in the subsequent 10 years. It's just not really debatable. We also find that CAPE so basically 1 over CAPE, which is their yield, is statistically more pervasive than earnings divided by price versus predictability. That's fine. So basically, at the end of the day, what does this all mean? if you're going to smooth out earnings, which is what CAPE does, and I agree with that 100% because we have anomalies that happen all the time. And the CAPE ratio is well above his historical norms, which it is. How are you going to account for a historical probability of a 10% return on stocks? I don't know how you could do that. And it's Siegel, even though he doesn't do that, would not argue that either. Now, what we do on the John Bogle model would say, and Siegel does this too, earnings growth year over year plus dividends year over year would give you your gross return. The problem that is we're getting a lot more dividend payouts. We're getting more stock buybacks, but stock buybacks actually increase your earnings per share. So you got to look at earnings. But you have to factor those over a smoothing period. And